In 2016 and beyond, there are three words that are going to be key drivers of insurance M&A activity in the Asia Pacific: technology, innovation and disruption. With the business commentators focusing on the insurance mega mergers, we don't hear a lot about the fintech tsunami that is heading straight for the insurance sector. Having successfully disrupted the banking and finance industry globally, the fintech community is now turning its attention to the undisrupted behemoth that is the insurance industry. Whilst insurance innovation and disruption technology is nowhere near as developed as other parts of the fintech market, that's about to change. From policy comparison engines to tech-enabled health coverage, to car insurance by the mile, to instant valuations for personal property, the disruptors are invading the multi-trillion-dollar insurance industry, and investors, including the insurers, are chasing them. When it comes to adapting to innovation and change, the large insurers don't want to be the Kodak of the insurance industry. My DLA Piper colleagues in Silicon Valley are telling me that insurance fintech disruption are so hot right now. There are now hundreds of startups targeting the insurance sector, not only on the west coast of the US, but also in Singapore and Hong Kong as the Asia Pacific hubs for insurance, as well as India and Australia. In the first 3 quarters of 2015, technology companies targeting the insurance space raised over $2.4 billion US. That's double the total amount of funds raised in the preceding 4 years. And the large insurers, including those in the Asia Pacific, are at the front of the queue in ramping up their investment activity in this space, whether by direct investment, investing through their corporate venture capital business arms, or through the establishment and participation in various innovation hubs and startup incubators. Whilst insurance companies will continue using M&A to fill their product offering and build scale, our clients tell us they are focused on making sure that they are across emerging innovators and disruptors, and in particular, the way in which they will transform the way they do business, but also the customer experience. It's a reality that our clients have to be focused and active in this space if they want to maintain their market shares and competitive advantage. This means being active in early-stage technology M&A and considering every opportunity to acquire the disruptors and their products in a world where they are taking an ever larger chunk of their market share. One client told me recently that if they come across a disruptive technology or innovation that could provide them with an advantage over their competitors, the checkbook is well and truly open. With competing investment teams now on the ground in the technology hotspots, insurance companies need to adapt quickly to the fierce pace and competition that is fintech M&A. With the dollar value of most M&A investments in emerging fintech companies really representing not much more than balance sheet rounding items for the large insurers, and with directors and senior executives taking a much greater interest in fintech and disruption M&A activity, the natural result will be an increase in the volume of fintech M&A in the insurance sector. Whilst industry commentators will maintain their focus on the mega deals by the Asian giants such as Fosun, Ambang and Daiichi, as well as the continuing consolidation activity in the Southeast Asian insurance market, my prediction as an insurance and fintech M&A specialist is that we're going to be spending a large part of our time this year on increasing volumes of small and fast fintech M&A deals in the Asia Pacific.